Good morning, everyone. We have a special guest in the studio.
Hello, hello.
The winner of our trip to Hawaii. He's actually here.
Aloha.
Aloha.
Hey, Lee Potts. We'll see you soon, I believe.
Sounds good to me.
Oh, nice shirt.
I have
We're
a
still
whole
working on
collection.
our. You see, Julie? We're coming from our new office. This is our. Okay.
Background looks familiar.
So this is our new office. This was the easy button. I went to a listing appointment, older lady. I asked her what's more important, time or money. She said time. We basically bought it for $850. We put 110 into it. I could probably sell for about 1.6 today. But I'm gonna keep it. And this is where our office is. Funny how God works sometimes. It's perfect because we're gonna tear down our house and we needed another house to move into anyway. So we're all here. All right. Hey, before we get started, I wanted to Kapil, we're really proud. There's this thing called American Idol, I guess, right? And I heard there was somebody from Hawaii that actually won it. So I wanted to share that with you real quick. Kapil, can you show that? It's like a minute. Did anybody see this?
Yep.
It's pretty cool. I can't hear a thing. Kapil, I can't hear a thing. Oh, I think you got to share sound. This is a glimpse of our island. Have you seen this video?
Oh, I haven't seen the video.
All your wit, all of the lies, your grin, stay in
How
my
long for?
for all of time.
This is actually not the video.
Where do I go from here? No, I'm lonely, but have no fear. 'Cause I'll be seeing you, seeing you. Wherever I go, ooh, I'll be seeing you, seeing you, wherever I go.
Can't get enough of American Idol.
All right. Sorry, that was the wrong video, but anyways, I'm glad it worked. Okay, today we're going to talk about understanding trust. And let's get started. So as we all know, we have an equal housing opportunity for Keller Williams. We're pledged to the letter and spirit of U.S. policy for achievement of fair housing.
Dan, sorry to
Yes,
interrupt, but you're not sharing the screen.
I am not sharing the screen. Okay, how come? Let's see. I guess it's this one. This one. Yeah, I didn't have it. Can you see it now?
Everybody. Yep.
Oh, you good? Oh,
We
Okay,
can
thanks.
see you.
Yes, we
All
can.
right, thanks.
Yes.
So also, along with our disclaimer, we do have to comply to the TCPA, federal, state, and local laws, ladies and gentlemen. Right now, we as a company, Gary Keller is being sued for $1.1 billion with triple damages. So it's because of agents that aren't stopping to call people that they should not call. So I just want to be really careful We don't call anybody that we're not supposed to be calling. Texting as well, you need a double opt-in to make sure that you're 100% bulletproof, right? So be careful, do not get us in trouble and get Gary in trouble. And here's our disclaimer. This presentation's material is not provided by Keller Williams. It's really provided by me. So I am not an attorney. I'm not a CPA. I'm not a financial planner. I'm not that smart, and I don't play one on TV. Okay, so just know that this is just information that we've learned over the years, and we found that it's going to be helpful as a realtor to know some of this information. Okay, what I would recommend you do is find people in your market and dive deeper into this information and correct it if it needs to be corrected for your state, or at least you'll be a head up when you do meet them. Okay, here's what we're going to cover today. What is a trust? Many of you know, some may not. What I've found traveling around the country is not every market do they use trusts, which is really interesting. And in lower price point markets, maybe not. Right? We're going to talk about 6 categories of the trusts. We'll talk about the estate trust and the exemption limit, right? And we're going to talk about, if you're a trustee, what's your role, what are your duties, and the 21 responsibilities that you have. By the way, the foundation of most of what you're seeing is our seminar that we've been putting together for the public. And so I just thought that since I'm training the public to do this, boy, it's been seen with such great reverence and appreciation, and we're also getting business from it. We thought that we wanted to share this with you. All right, so let's go ahead. So what is a trust? It's a fiduciary responsibility or relationship within one party. The grantor is like an owner. Grantor is giving the second party, the trustee, the right to hold and direct the property and assets for the benefit of a third party. So there's 3 sections of this: a grantor, a trustee, and a beneficiary. Many times a trustee is going to be the beneficiary. In some cases, it will not be. Sometimes you'll have large trusts that the trustee is actually a trust company, right? And those are the folks that you want to get to know. We've spoken at the largest 2 trust companies in our state. Are going to do it again in the next week or 2. So know that this is a great source of information for them as well as yourself. And what is a trust? It's basically an instruction manual, I call it, to determine how a person's money or assets will be managed or distributed while they're alive and after their death. Okay, so it could be for both before and after death. So it's going to fall into 6 major categories. You're going to have living trust or testamentary trust. Most of the 99%, 95% of them will be living trusts. Some are going to be testamentary trusts. Funded and unfunded, we're going to talk about that, and revocable or irrevocable. So these are the basic categories that you're going to have in a trust document. Okay. So what's a living trust? It's basically a legal document that one person transfers ownership of their assets to a trust during their lifetime. So a living trust is done while you're alive. Okay, it's done to protect the assets, but also to have instructions to where it's going to go. Now, the grantor, the person who owns it, still remains in control of the trust during their lifetime, right? Because that's their trust, right? Up until their death, right? And then the assets are managed on for the benefit of the beneficiaries, right? So they're going to name beneficiaries in there, typically their family, oftentimes. And it's what happens after death. That's the instructions. And it's really the biggest value it brings is protects you from probate. And we're going to talk about what that looks like. Avoiding probate, what does that do? It provides privacy. So the worst thing about a probate case is not only is it expensive, and it could run tens of thousands of dollars to hundreds of thousands of dollars if it's contested. So time as well. I mean, it's going to take months to get through it. On average, 3 to 6 months on a non-contested. We have a case now in our state where one of the wealthiest people in our state, developer, they're on 32 years of litigation for that family. and they're spending all of their parents' or grandparents' money in lawsuits. Unfortunately, it's a contested probate. They're contesting who gets what, right? Because there was no trust involved, right? And so it protects you also for privacy. See, because know that the probate process is a public process, which means everything you own and everything you owe will be public knowledge. Everybody in the world will know what you own. So those with wealth, yeah, they don't want it public at all, right? They want that private. And so it's really about protecting yourself. Hang on a second. Matt, one second. Sorry, it wasn't prepared. Privacy. It also creates a little bit of flexibility for you as far as what you can and can't do with your assets. And then what happens when you're incapacitated, right? What happens? You can even write it like we did for our kids, because when we wrote our document, our kids were young. And so they weren't able to have access to certain things until certain ages, right? You can even put in there that you're required to your kids to have a prenuptial, right? People that have a significant amount of wealth, they're going to protect it for their family and protect it from divorce as well. And it's really a protective bucket that you put assets in, right? So a trust is an entity that can protect it, your assets from people that you owe money to. It can protect it from probate. It can protect it from your family. So what's a testamentary trust? Well, it's usually and I haven't seen very many of them, to be honest with you. I know a guy that does a lot of them. It's special needs, right? Typically used in a will to provide management distribution of assets after the testator's death. After they're gone, what happens? And it's usually because the beneficiaries, the people who are going to get them the assets, they're just not able to manage them, right? And it's typically a special needs trust. They have a one child that's handicapped or special needs, and it's designed to protect them, designed to give them enough funds to live a normal life, protection services. It also could be for people like if their beneficiary is addicted to something, you could write things to protect them that way as well. So not very often used, but sometimes very valuable if you see it. And it's provide beneficiaries over a longer period of time versus just a one lump sum distribution. Typically, a trust says upon my death, the assets get split up between the family, and that's a one lump sum distribution. This can actually last longer for the lifetime of the beneficiary, and it can even be for their heirs as well. And then it's really designed to protect it from creditors and predators. Make sure that that person who needs care gets the care that they need, and people are writing this so that they take care of their heirs. Okay, what's going on here? Funded trust. So what is a funded trust? It's a legal arrangement in which a grantor, the owner, transfers the assets to the trust and changes the title to the assets in the name of the trust. So just think of it this way. When you go to an attorney and you create a trust document, that's unfunded, meaning there's nothing in it. It's a protected bucket that's empty. What you have to do is fund the trust. And that was an aha many moons ago that I realized, like, what do you mean? I thought I built a trust. The attorney's supposed to do that. No, that's your responsibility, right? Now, when you're building the trust, the attorney asks you what you own, they should help you to fund the trust. Many just don't do that. It's unfortunate. And so some people could have a trust, but when you pull up their title report, it's not in a trust. And then they go, how come it's not in the trust? I have a trust. So, well, because it never got funded. Okay, so you got to have them go back to the attorney, have them change the conveyance document to the deed to show that it's owned then by a trust, not by an individual. Yeah. So one of the first things that we do is when we pull the title report, when we pull the tax records, it typically states that. And if it doesn't, we're going to pull the title report to validate that it's in the trust or not. Right? And at that point, you're going to need a trust document to sell the property, because that's who has the ability to sign on behalf of the trust. It's an entity. Right? So the trust becomes the owner of the assets, and they're managed for the benefit of the beneficiaries, according to that agreement. So in that agreement, it could have stipulations by which you could put in, for example, the beneficiaries, upon my demise, the beneficiaries get access to the money. They get access to X dollars per year until they get to a certain age. You can even put it where I've had somebody say that, you know, if their son's a drug addict, that they have them tested, right? You could do things like that. Unfunded trust, what is it? It's a trust that's been created, but it has nothing in it, right? And it's shocking to find how many trusts are unfunded. And that's where you can come in and provide a creative plan to get those items funded, get them back to the attorney and help with that. Yep, chat. What's in the chat? Can you expand on how the trusts protect from creditors and predators? Is it simply due to privacy? No, it's much more beyond that. I am not an attorney, so I can't speak to the details of that. But they can't come back to that individual. They're going to go to the trust. By the way, that's why most lenders, when you buy homes, right? Most lenders do not want you to own it in a trust, right? It's an individual entity. So here's my suggestion to you all, and we as our team need to start doing this as well. You help a buyer buy a home, and they're buying it in their name. What if 6-12 months down the road, you had a tickler in your system that said to them, hey, do you have your property in a trust? Well, you know the answer is no. And if something were to happen to you, if you were to pass away, do you know what happens? And they're going to probably say no. Well, likely it's going to go into probate. And if it goes into probate, your heirs are going to have to worry about the lack of privacy, the cost of doing it, the stress, and not knowing how to get through the process. So do you want to protect your heirs from that? The answer is yes. Okay, so here's my suggestion. I'm going to give you 3 names of trust attorneys, and I'd like you to reach out to them and let them know that you wouldn't want to build a trust. What happens in that case? What are you doing? You're creating a relationship, giving a contribution relationship to an attorney. You're feeding them business, right? When you feed them business, what happens? They're going to start feeding you business, right? And I think that's a relationship that you want to build on. And if you really care for your clients, if they have some wealth, any means of wealth, you want to protect it, right? So that's just a simple thing that you can add into your system. I just had my trust attorney tell me to record a beneficiary deed, make the trust beneficiary on all my properties, rather than record them in the name of the trust. That's interesting. In your state, if that works, then good for you. I can't speak to that in your state. In our state, it's just so much simpler to have it in a trust and have your trust dictate the rules of the game for you. How often should grantors of the trust audit their bucket? Good question. You know, the simplest way to do that is, what do I own, right? And is that protected? That'd be my question to myself. So every property you buy, yeah, you probably want to put that in the name of the trust if it's significant in value. If you're buying a $50,000 home, I don't know if it's worth it, but if you're buying a $500,000 property, yeah, you probably want to put it in your trust. Okay. The trust agreement has been established, and the trustee and beneficiaries have been designated, but again, there's nothing in it. What good is a trust if it doesn't have anything that it's protecting? Right? Or the grantor has not yet transferred any assets into their trust, and that's an important process. Because without the assets in the trust can't fulfill its intended purpose. It won't protect anything. Revocable trust, it's a legal arrangement where the grantor transfers ownership to the assets into the trust, and they keep control of it during their lifetime. Right? You can modify and revoke it or terminate it at any time. It's revocable, right? You can modify or change it at any time. And that's going to be in a form of an amendment. And so when you get the trust document from your clients, ask them for their trust document, and all the amendments. We had a client that amended it 12 times because they had trouble with their kids. And they kind of iced them out because the kids were not acting appropriately. Yeah, it can happen. And so you never know. You want to ask for those amendments as well. The trust becomes irrevocable upon the grantor's death, and the assets are managed for the beneficiary. So once somebody dies, typically you can't change it. Right? Typically, it's irrevocable upon death. You can change it at any point in time till you die, but once you die, you really can't change it unless there's agreement between the beneficiaries. Now, the flexibility and privacy and avoiding probate are really the biggest benefits of owning a revocable trust, of having it in there. Irrevocable trust, it's an agreement where you transfer the owner's assets into the trust without relinquishing in control of it. But this typically cannot be modified or amended or terminated without the consent of all beneficiaries. So when you see irrevocable trust, most people think I can't change it. True, you can't unless all beneficiaries agree. I didn't realize that. I always thought that irrevocable means nobody can change it. And it is possible as long as the beneficiaries agree. The assets are managed for the benefit of the beneficiaries according to the trust agreement, same as a revocable trust. In certain instances and states, though, irrevocable trust can be modified. But again, look at your state law. And this is the main reason I'm saying I'm going to give you a rough overview from what I know, but please don't believe that this is going to be absolutely the word of truth in your state. And this is where you're going to come in and you have some basic foundational information and you want to talk to the experts in your market. Okay, build relationships with them. It's a form of asset protection because it shields it from estate tax and tax planning and Medicaid eligibility for some benefits. So when you work with Medicaid specialists, they only do irrevocable trusts because it's required for Medicaid. Who uses the irrevocable trust? People with wealth, people beyond the state tax limits. We're gonna cover that in a minute. So there's this thing called generation skipping trust where you can skip from one generation to another. And I thought I'd better talk about that because you might encounter it. Why do we do that? Because it saves you on estate tax. It can reduce the amount of taxes transferred to assets of one certain generation and pass on to future generations without incurring a gift or estate tax. It can provide a layer of protection for the assets and keeping them in the trust for future generations and protecting them from creditors and divorce as well. Right. And you still have control. It allows you, the owner, the grantor, to control the assets and maintain some level of control. And how it's used and distributed, even after you pass away. You can say that it'll go to my grandchild under these conditions. Right. And it definitely avoids probate. All these trusts will avoid probate. And it can provide a benefit for future generations, right? You can make sure that the assets are protected and preserved and passed down to the future generations that you desire. Because oftentimes the immediate beneficiaries, their children, they don't need anything. They're fine financially anyways, and they would want to bless their kids. So grandma does a generation skipping to the grandchildren. We've encountered a lot of this here in our market because of that situation. We're dealing with wealthy people that their kids are doctors and lawyers and they're well off. So they don't want the money because it adds to their estate tax. Therefore, they want it passed on to their grandkids, right, or their kids. So what is estate tax? It's levied on the total value of the deceased estate. So it's charged to the estate, right? And there's a limit up to 12.92 million. Everything up to 12.92 million is exempt. I mean, there's no tax on that. It's when you get beyond, that's why I'm saying estate tax only impacts the uber wealthy, people that got over $12.92 million of assets. If they don't have it, that's not really a consideration. But you're going to find people with a lot of wealth. You're going to find people with, tens of millions of dollars of assets because they have the assets in their real estate, right? And if they've got a number of them, yeah, they're going to want to have a plan. And guess what? It's 18 to 40% above that number, above 12.92 million. If they got $30 million, think of the tax consequences to your kids, and they're not going to be able to pay the tax. So what do people do? They put in an irrevocable trust so that it's not included in this number of 12.92 million, right? That's how you shelter it. You protect it with an irrevocable trust. So here's some states with estate tax, not that many of them. So if you see your state there, the 2022 exclusion amount was up to this number. What that means is in DC, if you have 3.9 million, you don't have any estate tax. Once you get over 4 million, then you're charged 11.2 to 16%. And I don't know how every state is calculating the difference because they're pretty wide. From New York, it goes from 3% to 16%. Hawaii is 10 to 20%. In Hawaii, it's only over 5.5 million. Right? And so there's going to be a lot of wealthy people you're going to come in contact with. There's 38 states without any estate tax. Right. So if you live in those states, then you want to know that, yeah, if somebody brings up, I'm worried about estate tax, I'm not quite sure if you have any. My understanding is you may not. You may want to check with your CPA on that. Yeah. So I'm never going to give somebody a definitive answer. Here's what we understand is a good line. Here's what we were told. Here's what we found. But don't be careful on the definitive statement of this is what it is. Because again, we're not tax experts, right? And tax laws change. So if any of this is incorrect, we need to know, please, in our community. 6 states with inheritance tax. There's only 6, interestingly enough. The difference between estate tax and inheritance tax is the estate tax is paid by the estate, right? The inheritance tax is imposed on the beneficiaries that receive that money, right? And there's only 6 states with that. So you could have both. You could have estate tax and inheritance tax in certain cases. So just know that this is some information we found as we started digging into clients having more wealth in other states. So what's your role as a trustee? You have a fiduciary duty. What does that mean? You're acting in the best interest of the beneficiaries at all times. And you're going to act with loyalty, prudence, and care when managing their assets, which includes how it impacts the beneficiaries, right? The decisions on behalf of the beneficiary. If the beneficiaries choose a different route, then we need to have a fiduciary responsibility around that. Asset management, it's really being consistent with the objectives of the beneficiary's best interests, right? You're not putting things in areas where it's not generating enough money or is it too risky, right? So asset management. And then record keeping. They have to keep accurate and complete records of all transactions and provide regular accounting to the beneficiaries. So it's a big role, as you can see. There's a lot of responsibility here as a trustee. And then communication, keeping everybody informed throughout the process, which is all the beneficiaries. If there's 15 beneficiaries, so be it, right? Everyone needs to be informed equally based on the information in the trust. So what are the duties of them? The duty of loyalty, acting in the best interests of the beneficiaries and avoid any conflicts. The duty of prudence, providing reasonable care. And duty of impartiality. So whether you like the beneficiaries or not, that is irrelevant to your job as a trustee. You must treat them all fairly and equally and impartially. And sometimes that's a challenge because sometimes some of the beneficiaries aren't real nice. And you're going to have to deal with that. Yeah, because that's the duty of impartiality. The duty of confidentiality, all this stuff, you cannot be posting on social media what's going on. You can't be telling anybody what's going on. This is confidential, right? And then the duty to follow instructions. Yeah, you just got to read it, follow it, understand it. If you have any questions, ask the attorney. But they have to follow the terms of the agreement. It's an instruction manual, right? So you follow the instructions, and it does have to apply by all local, federal, and state laws and regulations. Okay, so 21 responsibilities you need to know. Now, why did this all happen? 1 week, I got 3 phone calls from 3 different people independently that says, Dan, I want to sell my house. And I'm a trustee and I don't know what to do, right? And initially I didn't know how to help them. So I said, you know what if I could outline everything that they need to know? What if I could guide them through this process? And what if I could educate the general population? So that's what we did. And this came from our presentation called I'm a Trustee, Now What? Because that was exactly what we happened. 3 people called me and says, I'm a trustee, I don't know what to do, now what? And so I met with attorneys, we dove deep into these, we talked to trust companies, and we found out there's 21 things you need to know. So let's rock and roll and go through this. Then we'll leave some time for Q&A at the end. Number 1, you have to have original death certificates. How many? They say a minimum 10 to 20, depending on the number of accounts. Just think of every account that you have has to have an original death certificate. Otherwise, they're going to need evidence that that person is no longer alive. Okay, every account. So retirement account, life insurance, long-term care, anything that has assets to it, real estate. Right? You can't have a transfer of real estate without a death certificate. And second is you want to study that trust document and follow the instructions, and you're gonna have to read them. What I learned early on in my career is if I want to spend a lot of time with the wealthy, I need to know the tools that they use. So I read every trust document for many, many moons. Now I know where to look for the document to see who has the authority to sign, to see if there's anything weird in it. And we can also sometimes glean out their relationships with their kids based on what it said. But most of them are pretty general. They're not that detailed. 90% of them are going to be very simple. They're going to follow the same kind of guideline. What you're looking for is who has the authority to sign on behalf of the owner. What happens when somebody passes away? And what are the instructions at that point? Number 3 is you got to record all their accounts. So you need to make a list of everything that they own, their financial institutions, all their banks, their credit cards, retirement accounts, investments, look for other beneficiary designations, right? Because even Social Security, which we'll cover later. Records of debts, right? They know that when that person passes away, the debt doesn't go away. So the mortgage still has to be paid, right? The car loan has to be paid. And as a trustee, that's your job to make sure that gets done or close the loan. So how are you going to do that? You got to go find them, right? You need to know every credit card that's out there, every mortgage that they have, whether it be a first mortgage, a second mortgage, whether it be a HELOC, car loans, student loans, and anything they have debt on. Right? Copies of the insurance policies, right? You want to get their life insurance policy. You want to make sure you understand that. What does it say? Who's the beneficiary? How do you get a hold of the money? There are health benefits, right? Disability benefits, long-term care, Medicare, homeowners insurance, auto insurance, all these things. You see how overwhelming this could be for most people? This is wildly overwhelming because most people, this is 5 out of 21 and we're already overwhelmed. And here's the thing is most people don't even know that they're responsible for these things. Right? And when we go through our class and we teach them, it was a big eye opener. And you know what it does? It says, I need to stay close to you because you know how to help me. And that's why you want to do these seminars, because people are gonna come with real estate and they're gonna want to do a 1031 exchange. That's basically the end result of why we do this. We're getting listings. Contacts of Social Security office, how many knew that you had to contact? You actually had to let them know that there could be a death benefit to the survivors to that, right? And then you also want to add it to it. There's a master death list. Get this. Never knew that existed either. The government has a master death list. And what that does is it helps you prevent from fraud, because when somebody dies, the bad guys are going to go in and pretend they're them. And they're going to use their social security number. They're going to take money out of their assets. Well, my understanding, and I'm not sure how it works in total, it'd be good if somebody learned what that meant, is that master death list, how does it prevent fraud? I know it does. I just don't know the details of it. Then we have to report the death to credit reporting agencies. Yeah. Let them know that this person's passed on. So nobody else can open an account in their name and present themselves as that person that's dead. That's huge area of fraud that's real prevalent in our country today. People looking for people who passed away and taking their identity. Yeah. But getting in front of that will help protect their claim. Contact utility companies, kind of normal, you'd think so, but many people just forget. Oh shoot, I forgot to call why is my electricity out at mom's old house now? Oh, that's right, I didn't pay the bill, or something of that nature. And that can go all the way down to the newspaper, right? The post office, you want to make sure that no mail comes to that address anymore. Once somebody passes away and the house is vacant, people will know they're vacant and people will go to their mailbox and they're going to steal their identity. The same thing. So you want to get to the post office. I believe they're going to require a death certificate as well. And also probably the trust document as well. That shows that you're the trustee and you want to reroute that mail to you, whoever the trustee is or the executive administrator of the estate. You don't want the mail going to that house. You want to go to you. Other governmental agencies, the Veterans Administration, if they're a veteran, and there's benefits, survival benefits there. Homeland Security, oftentimes as well. Motor vehicle registration. So cancel the driver's license, number one, because obviously they're not going to be driving. The ID, state ID, license plates, you want to remove those or transfer them if they're a vanity plate. Disability placards, all registration of everything they have, from a car to a boat to a trailer to a moped, all that should be changed, right? And the ownership be transferred to the heirs or sold. And then the employment benefits company, whoever they work for, there may be some death benefits attached to it, right? And so you can help there. And then making an inventory list of all the assets. And that's probably one of the hardest jobs. I mean, there's a lot of tough jobs in these first 13, but making a list of assets is even harder. Why is it harder? There's a lot of emotional attachment to some of it. What will happen when somebody passes away is their heirs will say they want to take ownership to things, personal things, property, personal property. And your job is to control that. They actually don't have a right to just take things out of the home, right? Without approval from the trustee. Right? And there has to be an agreement that from the family or the beneficiaries, I should say, who gets what. And that should be in a controlled environment. So believe it or not, to do this properly, once somebody passes away, you should change the keys of the house and do not let anybody in without an agreement on what's going to happen to the stuff. Because that's where we see fights. We see fights where they come in and they take mom's jade bracelet. What happened to mom's jade bracelet? Well, Sue Ann took that. No, why did she take it? Well, because she liked it. Well, then the brother goes, oh, well, that's not fair. You should have sold it. You know what I mean? So there's a lot of areas of dispute that show up with personal assets. And as a trustee, you're responsible to not let that happen. Close all their email, social media and website accounts. That I do quickly, because once people find out that somebody passed away, the bad guys go directly in there virtually and take ownership. Canceling all the club and organization memberships, whatever memberships that they have, and cancel those so nobody has access to it. A time of death appraisal. So what is a time of death appraisal? It determines the value at date of death of real estate. And I believe it actually could be of any asset, but most impactful to us is real estate. Why do you need that? Well, if the family is planning on keeping the property, know that there's a step up in cost basis upon the passing of somebody. And what that does is if they bought it for $25,000 and the asset now is worth $1 million, and when they sell it, you get a step up in cost basis where now the value is $1 million and you sell it at $1 million, there's no gain, right? Well, if you're selling, here's what I'm told from CPAs is, and when somebody passes away, if you sell the property within 6 months, typically, and check with the CPA, the IRS typically sees the sale price as the date of death appraisal, which means there's no capital gains tax. Again, please take a look at and speak to the CPA on that. But that's what I've been told. I've never heard anything other than that, but I'm not the CPA. Right? So if they're planning on selling it, I typically say, check with your CPA. And they've all told me that, yeah, you're okay. Now, if you're planning on holding it for more than that time period, you're probably, let's say the daughter is going to live there and she's going to keep the property, then you're going to want to instruct her to get a time of death appraisal. We've actually had clients that wanted to sell their home and I found out it was transferred to them 20 years ago. Well, what had to happen is we had to get a time of death appraisal 20 years ago. That's a forensic investigation, basically, on the value back at that time, which is oftentimes more expensive, right? And so know that that's something that is a very valuable, important thing to do. Contacting their CPA or accountant and get their tax returns, because now you're responsible to file tax returns for that person, right? You're going to get an EIN number. It's a federal number. What is it called? Employee identification number for the federal government. Once somebody passes away, you have a social security number until your death. And then it goes into an EIN number. And then you file your estate returns that way. Okay. Again, I'm not a CPA. I don't know the details of that. But these are things that we found that are helpful for people to make sure they get. Contact the financial planner, obviously, making sure that you get all the accounts, making sure who's the beneficiary of these. You're going to have to transfer those funds, right? And distribute them at some point. Contact your real estate planner. How about that? That's number 19. Because you want to gather all their property information, including their timeshare, anything that they have in real estate, whether it be in the United States or outside the United States, right? You want to be able to steward that process of transfer of ownership, building, protecting, and transferring wealth. 20 is communicating and educating and resolving the disputes with the beneficiaries. That's a tough job. The sooner you get in front of it, the sooner you understand your role and explain that to the other beneficiaries, they're going to have greater respect for you. They're going to have greater understanding of the process. They typically won't give you as hard of a time, but they don't know what the trustee has to do. They just think the trustee is telling them, giving them orders. They don't realize the role and responsibility and duties of a trustee. And once you communicate that to them, they're oftentimes more likely to accept you as the person who's got the most amount of work on their plate, and then they'll cooperate easier for you. Last item, number 20, is once you've accounted for everything, once you've paid all the taxes, you distribute the assets. What I've heard in many cases, they do this in 2 cycles. First cycle is you're going to distribute a certain amount of money, but you're going to keep a certain amount of money to make sure that you have enough in case something else shows up, right? And then you can distribute the rest. Once all the bills are paid, once you've done your forensic research to find out what are the expenses, what are the debts, making sure there's enough money to close all the accounts, and then you just do the final distribution of the assets. And that could take months and years to do. Depending on how quickly this process goes. Right.
Hey Dan, we have
Yes.
a couple of chats there.
Go ahead, let's see. Let's see, my understanding is that you should have two appraisals. Chad Tillman, by the way, Chad is an attorney. He's in our community. There's Chad. He's also helping us protect KW Real Estate Planner. And we'll probably have to have Chad on this call at one point as a guest. Chad says to everyone, my understanding is that you should have two appraisals, one at the time of death and one 6 months later. You can take the highest appraisal for a stepped up basis. Good to know. I think that would be a question for their CPA because it would impact their taxes most importantly. But yeah, that could be a good thing to do. Vinny says, I have had attorneys accept a CPA. I'm not sure if I'd ask the attorney about that, Vinny. I'd ask the mayor CMA. I'd ask the person who's going to file their taxes, right? Because attorneys, unless they're doing their taxes as well, that's not their area of responsibility in regarding taxes. Oh, he was a CPA. Perfect. He was both. Great. So I mean, yeah, I would take his word 100%. Thanks, Vinny. Is the trustee typically compensated for their work? Yes. If so, how? That's another good question. Chad Tillman, do you know how they're compensated? I know there's a national scale of this, I'm told, but I don't know how that works.
It's a percentage of the trust.
Percentage of the trust? Yeah.
We're going
The
through it.
value?
Yeah, it's like a 3 to 5%
Okay.
that they get.
Cory's mentioning he's heard that's 3 to 5% of the value of the estate.
Of this, yeah.
Yeah. Okay, so this is what we're hearing. So again, talk to your client's attorney and CPA on that. What other questions do we have? Do you know if a broker professional opinion can be used at time of death appraisal, or do you have to have a formal appraiser? I plan for the worst and hope for the best. So I'm going to say, from my personal opinion, I'm not going to do a BPO, a broker price opinion, to determine that, because I'm not sure if the IRS will accept it. I'm certain the IRS will accept a certified appraiser, though. Right. And so to avoid audits or red flags in the transfer, my suggestion would be an appraisal with a certified appraiser. Let's see. What else am I missing? Good read. Another good reason to get a transfer from my property. Yep. Is the trustee responsible for accounts that have direct beneficiaries? Yeah, absolutely. Because the trustee is responsible to fulfill the instructions of the trust. Right. There's a trust document that has instructions. Somebody has to make sure that that's been fulfilled. And that's the responsibility to make sure that that actually happens. Can we get a sample trust? Yeah, I think we can. Julie, is there some things in our trust that we can share, our personal trust? We could probably redact some of the things that we don't want to be public, but we can share yours. Fiduciaries to the beneficiaries, not the grantor, or even in a trust. I'm not sure what that means, Jennifer.
I think I was just asking, since everything said the beneficiaries are get the fiduciary responsibility, if it's a living trust, does the grantor not have as much fiduciary as the beneficiaries do? Does that make any sense?
Oh, well, while you're alive, you know, you are the beneficiary. You're the trustee typically. Yeah.
Okay, got it.
But it happens after passing. Okay, let's move on. I think we're almost done. So this is a simple chart. You can use that. It's in our portal. What I need to do as a trustee, you could have that out for your clients and give them a rough idea. We even have that seminar PowerPoint presentation and a video. I think I'm doing that. I did that last month. I'm doing it again on the 31st of May. No, Yeah, on the 31st of May, we're gonna shoot another one here locally in person. So here's some homework for you. We're 10 minutes out of finishing up today. Number one is make sure you do your knowledge check. So just do it now. It's not that hard. Get it behind you and get certified in that area. Complete all the past trainings and sessions that you've missed and get certified in all of those things. So think of it, guys. There's 8 hours a month of training that comes out from our community. My question is, how much of this are you actually getting into? And is it going to be beneficial if you did? And what I found is there are a number of people in our community that dove deeply into this and are really rocking everyone's world right now. They're getting listings in a big way. Cory, can you share with me? Cory, tell us real briefly in 2 minutes, what does your business look like today and why did that happen?
So I went from a single agent to there was 9, but there's above 6 people on my team still. I believe our second quarter is going to be better than my best year ever. And I'm a top producer, so I do pretty well. In this last 2 weeks, we've taken listings rather than doing a listing presentation because we're focusing more on the capital gain tax assessment, how we can help them and how we're eliminating their taxable gains. So it's definitely separated me from the bunch. We even have realtors that are referring us business because they're not confident in handling
In your own market center?
in our own market center.
How's that, guys?
Yeah. We got one is going to end up being $6 million worth of real estate because they were not confident in doing a 1031 exchange and transferring it.
There you go.
Yeah, so it's been
How many listings do you have now?
5.
You have 5. How many do you have in escrow? 3. Okay. And you told me yesterday what happened yesterday. We were playing golf yesterday.
Yeah.
Part of his trip, he gets to pick anything he wants. He wanted to pick off.
Golf, of course. I tried to surf, but it was more just paddling out into the ocean.
He got wet. He got wet. You know, he got some exercise.
So on Tuesday, when I was here, we got a listing appointment for someone from one of the seminars we did.
Yeah.
And then we got another one who heard about me through social media and knowing that I can handle the nuances. Their parent just passed away, so we're now going to help them prepare the house and get it in the market.
Cool.
So yeah, it's a good.
That's a
it's
good day. Yeah, for not being at home.
Yeah.
Not being at home. I got a call yesterday. I spoke to a CPA who's a financial planner. And he had done a presentation in a market center. The agent in there, I can't remember who it was. Lucky, I think it is.
Yeah.
I don't know if she's in our community or not, but she said she started talking about the 1031 exchange and the DST, and he was quite impressed by her. So he says, "Hey, I got a client that's looking to sell a property but I don't want him to pay capital gains tax. Do you know anybody that knows anything about 1031 exchange?" She goes, "Where is it?" "It's in Hawaii." Guess what? We're going to get the listing, right? And he calls me back this morning. He says, "Hey, I got 3 more for you." Right? Think of what can be done in your business when you're connecting with the right people. And the way we've learned how to connect with them is through our training, right? And to get certified. Elevate your business, right? So the other thing we want you to do in your homework, share your ahas and success in our Facebook page. Please do that because I think that's how we all learn together. So here's some very important reminders. Our regional ambassador, we're opening up applications for regional ambassadors. We have a number of them. There's 31 regions in our country. We need to have at least one per region. And the last day to apply is the May 31st. We'll go through a vetting process with KWRI with our team. And hopefully within the next month, we'll have regional ambassadors that will go out and start training as well and joining us on special events that we do. And our t-shirt contest also ends on May 31st. I've seen some really cool designs out there. Yeah, I'm really excited to see those. Want to get those in production and make you guys famous on your artwork, but also to get more shirts out in our marketplace to separate us off from the crew. So what's next? Monday is Memorial Day. There's no session on Monday, so enjoy your day off, guys. And then on June 1st, what we're going to do is we're going to talk about understanding the 2 types of cost basis. I want you to be really clear on that, being able to deliver that to your clients, and how to calculate capital gains tax, right? We're going to talk about cost basis and then capital gains tax. and how you can do that very simply and create a duplicatable model around it. Okay. Is that good for you guys?
Make it count.
Oh, and Mega Camp, thank you. Mega Camp is coming around the corner. It is August 15th and 16th. We're gonna have a mastermind. KWR is giving us a conference room to have our own private mastermind on the 14th of August. So what we're gonna do is send out a survey to everybody, find out if you're going to Mega Camp, if you've actually paid and registered, we want to know that. Two, because we only have a room for about 200 people. So two, are you going to come to the mastermind and would you like to bring a guest? You can bring guests if you want, it's fine. But we need to know because we do have a capacity issue on that. And then after that, I'm just told today on Monday evening, there's a community reception that we'll all go to as a community. I guess there's food and drinks and stuff there. Okay. Any questions, any ahas before we end up?
Free webinar tomorrow,
Oh, we have a free webinar tomorrow. What am I doing tomorrow? Sorry, I don't even know what I'm doing.
26.
Free KW rep webinar. If you have anybody is on the fence or interested, if you're trying to recruit people into your market center or into your team, or even that's an agent that you thought that would be a good thing for them to join our community, that is tomorrow. What time is that? Tomorrow? I'm doing it tomorrow sometime. I don't know. We'll get that in. Put that in the chat, please.
Yes.
Hey, Dan, Roxanne here.
Hey, Roxy.
I'm right now doing a asset performance test on a client of mine that we've sold 27 properties to over the past 6 years, right?
Nice.
And it is so powerful, right? The conversation I can have with him on Friday is this, and this. I think we should be looking at moving that asset elsewhere, right?
Yeah.
And now I've got a place for him. I mean, he's never done real estate before. So I guess my takeaway on that is you're not going to get comfortable doing this until you just roll up your sleeves and do it, right?
Yeah.
And if you've got an appointment, I scheduled an appointment for a week and a half out, and guess what? I got a deadline now, right?
Yeah.
So digging into that, and right now, even being the toddler I am at this stuff, I've got 4 coming soons from this arena, and yeah, it's dig in, just start doing it. The need is profound, and there's nobody out here doing it.
Nobody's doing what you're doing, guys.
Dan.
Any other ahas? CW.
Yeah. Hey, so you'd asked me if I wanted to do a asset calculation deal. So our taxes went up here so much, taxes and insurance in our area. Like one of my properties went up 34%.
Wow.
On the assessed value. So that really made a difference. But I started reaching out to some of my investors thinking that, all of a sudden these properties aren't necessarily going to be as profitable as they were, and came across some people that wanted to look at possibly selling a couple of their investment properties and renting their home for 2 years, doing a HELOC first, renting their home for 2 years, and then selling them all. And it really was an interesting deal, which I don't know if we have time to look at it now or maybe the next time. But after I took it all out and figured out what they, what their rental income for the, they'll make, after selling all the properties, they'll do about $5,206 a month of income on the Delaware statutory trust at 5%. Or I'm sorry, that's their income from their rental properties. Or if they do 5% on the Delaware statutory trust, they'll make $6,208, which is kind of cool because they don't have to do anything anymore. So
Absolutely. Yeah.
Kinda
Quick example along the same lines is we have a client that has 2 properties. They have 2 children. They live in one and they don't live in the other. They both have significant gain. I'm talking capital gain tax burden of, I think it was $250,000 to $350,000 of capital gain, right? Of tax of the capital gain, not only the gain, tax on the gain, significant, right? So, because they're over $1 million each. So what we're going to do is the house that they're living in, the question was, how's your house working for you? He says, well, we're getting older and it's too big. We got to go upstairs to go to the bedroom. Say, okay, what do you want to do? Get a single level home. I said, okay. So tell me about the other one. How much money are you making other? Oh, we're not. So what do you mean you're not? I said, well, it's been vacant. Well, how long has it been vacant? 5 years it's been vacant. Like, holy smokes, 5 years? How much could you get in rent? $4 grand a month? Wait, so 4 times 12 is $48,000 times 5. That's $250,000 that we just vanished away. So yeah, we didn't have any plan. And so I said to them, so what's your goal? Their goal is to move into something single level. I said, I tell you, here's what we do. We sell the $1 million investment property. We go buy another $1 million property that you invest in, but that's your end all home. That's the home that you eventually move into. That's your single level 3-2 in the area you want, but you rent it for 2 years, right? Simultaneously, you move out of your house today, right? You rent your house for 2 years. You go rent some random place for 2 years. 2 years later, we sell your home. We take the Internal Revenue Code 121, the 500,000 tax-free dollars, right? He still has $500,000 a gain. And then after that, we go of the $500,000 in 2 years, he could sell that, take that 500,000, split it up in 2 bundles for the 2 kids at $250,000 each to start seeding them property values, right? To seed them their next property. 0 capital gains tax. We eliminated capital gains tax from their entire world. When if they were to sell everything as they were, they would have had over $500,000 of tax. Tax alone was $500,000. We're going to change these families' life. Right? Yeah, they're going to change their life. So these are things that, the only way to get good at making these strategies is understanding how to measure it. So we're going to measure cost basis. We're going to identify cost basis. We're going to measure capital gains tax. We're going to do asset performance tests to make sure we understand the return on its investment. And if you could make more money, like in CW's case, if you can show them that you can make more money elsewhere, would you? The answer is yes. You got a listing. And you
Hey,
got
Dan, I got a question. I know we're over, so I don't know if there's time for it.
Go for it.
When I am doing these asset performance tests, I've always only ever used the cash on cash analysis like for the first year, but my understanding from the material is that we can do this any year. When we do that, are we measuring it against their initial investment, down payment, et cetera?
No, it has nothing to do with down payment. It has to do with value, right? So what's the current value, not what they bought it at, but what's today's value? Okay.
Yeah, well, what I'm talking about though is the acquisition fees, cash invested, right? When I'm doing the cash on cash.
Yeah.
Am I using the original amounts or only what they've spent in capital improvements this year?
Good question. Are you doing the original amounts? I'm trying to think this. I believe it's well, when you're trying to do it's an investment. All the money that they put into it, basically all the money that you put into it relative to what you're netting out.
Gotcha. So that what would make sense to me is that you're taking the initial monies they put into it, the closing costs and the down payment and capital improvements, and then we're treating operating expenses differently.
Yes.
Okay, cool. So it's what they've put into the property, not what it costs them to keep the property going as an investment vehicle.
Yeah, the cap rate, if they the cap rate is helpful when you do that as well, right?
Yeah.
That's the snapshot of the point in time, right?
That's right. And how it compares to others. And with cap rate, when we're looking at the type of expenses that go into that, there are certain things. Obviously, what I got from the accountant for this guy is a profit and loss, so I immediately pulled the depreciation expense below the line because that isn't a part of this conversation. But things like professional fees, CPA fees, bank fees, are those considered operating expenses, you think?
If he didn't have that investment property, would he have those expenses?
Right. There we go. That's operating.
That's my question to myself. That's my test, right?
Okay.
And if it's if those fees are caused by the ownership of that investment, I'm going to add it.
Okay. All right. Good. Thank you.
Awesome.
Okay.
Well, we
Dan,
trust this has been helpful. Yes.
yeah, we have a question from Laurie Millam. I've just sent you in the chat.
Oh, sorry. I'm way down here.
Keep going.
Oh, wow. I'm way off here. Probably need somebody to guide this. Where are we? What was the?
Very good engagement.
Let's see. Listing an investment home for someone next week. She doesn't want to 1031 as she's tired of real estate, doesn't need the money. She thinks she'll pay the capital gains tax. Wouldn't the DST be that? The answer is yes. Well, here's a question. What's the capital gain tax liability? Whose question was that?
Already.
Laurie,
It's
what's
mine.
the how much in taxes will she pay?
I have not wrapped my arms around all of that yet. I've got to figure all that out. So this was a listing. She's a former client. She bought the home in 2012. I kind of mentioned
Well, let me ask you this. What did she buy it for?
142.
Okay, and she sells it for 300. So $160,000 of gain if you had to do rough numbers, right? Napkin
Right.
test. $160,000 of gain, 30% of that. What's that? 50 grand. So my question to her, when somebody says, I'm just going to pay the tax, my question to her is, how long would it take you to save $50,000? How long would it take?
Yeah.
She'll probably say, I could never save that. Well, you can do it in one swoop just by doing this now, right? If you could save $50,000, would you? See, you notice
The
I can get people to move forward without telling them what to do by asking them what to do. And you'll never be wrong, right?
The funny
So if
thing
they
is she
say-
is a financial advisor. So if I can teach her something along these lines and she has all kinds of connections, I just feel like that might open up. And she's got 2 young girls. So if we,
Oh my
I
God.
don't know, figure this out in some way, I'm just,
Yeah.
Yeah.
So would you advise your clients to throw away $50,000?
Yeah.
You're advising yourself to do it. I'm not sure. I mean, if you're advising them to throw away $50,000, I'm not sure if I'd want you as my financial planner.
That's right. You can rename yourself Bonfire Real Estate.
That's awesome.
So I have a one aha moment.
Yeah.
So what I've realized is in my listing presentation, my third slide now says, before we talk about me, let's talk about you. And we do a capital gains tax assessment and a asset performance test right then and there. And no longer do they ask me about what my commission is.
Yep.
It's not about the highest price. If I'm saving you $274,000 in capital gains tax, you trust me to have your best interest. And that has like catapulted the whole business. So I would just say start with that.
Yeah.
And it's
Yeah.
you won't have to
Yeah.
compete like,
No.
what separates you from the other agents? $274,000 and understanding how to get rid of it.
And the question is, did the other agents you interview have this conversation with you? And they're going to say no. So
They're going to talk about how good they are and
Yeah.
how they got you the highest price, but then.
what do you think we should do?
Well,
Well,
it's
when-
just another example of what I've seen in the investment property space for years. I've made a lot of my clients turn them into mom and pop big investors by helping them go find property that agents didn't understand the product. So they were listing it based on comps rather than based on income, and it was under rented. Right. So I could say to my folks, hey, this is a gem. Nobody knows what it's worth, least of all the agent. Buy it for this price, wait a year, jack the rents to market value, and you will have made, you'll take this thing that looks on paper like a 3% return and you'll bring it up into the 7s.
Just think of it this way. What if you spoke to everybody in your database, you took all their properties that they owned, investment properties, you ran asset performance tests on all of them, and you showed them where they are today. And then you go and find what's best in your market and you show them the difference. And the simple question is, if you can make X amount of dollars more every month without you spending a dime, would you? Who's going to say no to that? That's an automatic listing. It's so easy, guys. It's so easy, but it starts with knowledge and foundation, right? It's not how much money you make, it's how much money you keep, right? And that's where, that's the movement. And I mentioned that to the CPA and financial planner. He had a big grin on his face. It's like, you're the only guy you're the only realtor that understands me, that understands how to build wealth. It's not what you make, it's what you keep.
Such
Okay,
good stuff,
cool.
Dan. Thank you.
All right, guys. Well, have a great week. Enjoy your Memorial Day. Take care of you, everybody. God bless you. See ya.